Our next guest says that the Fed's decision to reverse its exit strategy signals that it has, quote, very low confidence in the health of the recovery. Economist Michael Feroli is one of our Bloomberg bests, which means his calls on the economy are among the most accurate predictions in the world. Michael is chief U.S. economist at JPMorgan. Before that, he was a Fed insider working at the central bank on its forecasting team. Michael, welcome back to Bloomberg News. Always good to have you on.
Thanks, Mark. Good to be back.
Michael, that Fed decision today saying this week it would buy Treasuries to help aid in the recovery. You didn't think they were going to make that move. Were you wrong or was the Fed wrong?
It was a little bit of a surprise, but it's understandable why the Fed did what they did. I think they're worried that the unemployment rate is stuck where it is, which is, I think they view as unacceptable.
Are investors panicking? You mentioned that unemployment number right now from what we saw today. Another indicator losing momentum. Initial jobless claims are rising by 2,000. It's the highest level we've seen since mid-February. How worried are investors?
Well, investors are worried, and I think rightfully so. The labor market looks like it's stuck, right? And it looks like we're in a place where we're not creating jobs, and I think that's very worrying, given how deep a hole the economy is in right now.
Michael, are we seeing that risk right now being priced in by the market, the risk of a double-dip recession?
I think that risk has been priced in to some extent, really beginning back in May, when worries about a double dip started to surface. And I think lately you've begun to see the data start to confirm that risk, which has been priced in for quite a few weeks now.
Well, as some of our guests have been saying, given what's going on in the economy, given everything that the administration and the Fed have been trying to do to try to jumpstart this economy, are the administration and Fed officials, are they out of bullets now?
Well, I don't know if the Fed is out of bullets, but I think what they have left is, maybe like rubber bullets or BBs. They're not really all that powerful compared to what they normally throw at the economy when it's softening. So there's not much left, I think, that policymakers can do to support the economy here.
Michael, I was earlier reading a message from our Margaret Popper. She covers banks, and she let me know that we are seeing bank stocks decline today, and correctly pointing out their earnings are more closely tied to the economy. What does that downturn in bank stocks today tell you?
Well, as you rightly point out, bank stocks are very sensitive to economic developments, and the news we got this morning on the economy certainly was not a very comforting one. Seeing jobless claims above 480,000 for 2 weeks in a row is not something that makes one really bullish on the economy.
Well, does that signal then, that downturn in bank stocks signal that the credit problems are just going to get worse?
Not necessarily. I think there are some other things going on right now. I think there are concerns about policy and how that may impact the financial institutions. But I think generally, you're seeing still a lot of concern out there about the economy, which does obviously feed through to credit issues.
Michael, if we can, in our last minute, let's talk about the bond market. Yields on the 30-year bonds hitting their lowest level in 3 weeks, and the yield on the 2-year note nearing that all-time low that was set yesterday. Are investors scrambling to move more money away from stocks and into bonds and mortgage debt?
I think that's part of it, but I think also you're seeing more confirmation that the Fed is going to be on hold for even longer than we thought prior to this week. And also I think you're becoming more, I think investors are becoming more concerned about the risk of deflation or about very low inflation lasting for a very long time.
And Michael, even that Fed action that they took this week, that's driving the yields right now, driving them even more.
Right, which is part of the intended purpose of that action. So in that respect, while the Fed commentary may not have inspired a lot of confidence, it is getting yields down, which is the desired outcome.
All right. Michael Feroli, JPMorgan Chase, joining us this afternoon. Michael, always good to have you on. Thanks.
Thanks.